Private sector credit growth remains muted, growing at just under 2% last month from a year ago. Money supply grew by 3.7%, and that's from 2.4% in June. Joining me with more on those numbers and the outlook are John Loos. He's a strategist at FNB Homeloans, Nicky Weimar, senior economist at Nedbank. Thanks both for coming in today. Nicky, PSCE up almost 2%, 1.98%. Do you think that could have been given a bit of a World Cup kicker?
Well, this is measuring South African spend. So, I mean, there may have been a degree of that activity coming through. Really, foreign tourists, their figures would be measured elsewhere. It would affect South African banks really through the transactional volumes and processes, and it might be measured in credit cards. And I think that you might see an element of that in other loans and advances, as opposed to the other categories of credit. So there might be a factor of it, but it is still extremely weak. And I think that's the story that's coming out of here. Over the month, though, we did see a nice increase. We're back at 2% instead of this sort of 0.1, 0.2%. So that is encouraging.
John, Nicky says still extremely weak, but do you think extremely weak is good in an environment like this where the consumer is still very indebted?
I think at the moment a very good thing, Stephen. Maybe ironically, it would be nice to have a rapidly growing economy. It would be nice to not have the risk of a double-dip recession, but I think that would be that is just not the real world at the moment. The risks are high. The economy has started to slow. Disposable income growth is very slow, and the household debt to disposable income ratio is still very high at 78.4%. And I think over the next few years we have to lower that considerably, which means probably what the doctor could best order would be relatively slow household sector credit growth for a few years and disposable income growth outgrowing it for a few years to a more healthy household financial situation.
How would you like to see it, Nicky? Because if you think back a few years, we had credit growth in excess of 20%. We had money supply growing by a similar number. Where would you like to see, what do you think would be healthy for the economy if we are to sustain growth going forward?
Well, clearly you would like to see income growing. Now, at the moment what we're seeing is wage growth, but we're not seeing employment growth. The best scenario would be if you have a combination of that. So you have strong employment growth, and that is accompanied by rising income. We're not seeing that, but there is wage growth coming through, so that is at least encouraging. Income recovered in the first and final quarter of last year, so that is a little bit better as well. But I think it's still very cyclical, still very driven by cyclical factors, because we're not seeing employment growth. So that's the one element that's missing. On the debt side, yes, ideally you would like to see consumers undertaking a period of aggressive debt repayment, bringing that overall level of indebtedness down to something a bit more respectable, because this credit cycle, unfortunately, if household debt to disposable income resides at the sort of levels where it is at the moment, will be relatively short-lived. I mean, your upside is short-lived if you start your upswing in consumer spending from around 78.4% household debt to disposable income. So yes, ideally, but I think that in the interim, if we're absolutely realistic about this, while all of these things are occurring, while employment growth is likely to be very slow, growth is the thing that is going to lag behind, and banks are going to operate in a very difficult environment.
Well, John, it looks like the category that you really focus on, that's home loans and mortgages, has been growing. And that's for the past few months we've seen this trend coming through where it's really been led by mortgage advances, hasn't it?
Well, no, installment sales has been at a higher growth rate, but mortgage advances 4% year on year, slightly slower than the overall household credit growth of 4.6%, but it's also been ticking up. I don't expect it to tick up much more or for very long, because what we are starting to see is a slowdown in the residential property market. And I think what we'll see in the second half, when the numbers come out for new mortgage borrowing, we will start to see that taper off. So, and that's as a result of a slowing economy and a lack of further interest rate stimulus. Any interest rate stimulus from here on would be very mild and wouldn't offset the big stimulus of last year. So I think by and large, I think mortgage advances for the next few years will be very slow, and that will help to contain the overall household credit growth for quite some time.
Just taking a look at interest rates, Nicky, because last week we had, of course, those growth numbers for the second quarter, 3.2%. We had inflation looking particularly benign. How does this kind of factor in when we're looking at the MPC meeting next week?
Well, I think given that the credit is certainly not showing any signs of running away on us, if you know what I mean, it really does look, it's starting to look like you've got a very, very benign environment. Certainly inflation is very low at this point. And consequently, we have actually changed our interest rate view. We've always said there's downside risk, but after this set of numbers, the inflation, the growth, and also these credit figures, we are now looking for about 50 basis point cuts when they meet in September.
And how about November? Because some economists are factoring in a second interest rate cut potentially in November.
Listen, I think if the world economy tanks on us and we enter a double-dip recession, maybe, they will have to consider further stimulus and bring down interest rates substantially if that is the situation. But I don't think that's a foregone conclusion yet. There's a significant risk that it may occur, but it's not a foregone conclusion. We still have the US that is stimulating. We still have China that is growing, even though they're trying to slow things down. So I think really that scenario where you now have a series of further interest rate cuts would really to a large extent depend on what happens in the rest of the world and how the world economy pans out from here.
What's your view on that, John? Because with last week's inflation numbers, we now have a real interest rate, which is about 2.8%. So looking pretty high when you compare it to other countries. Do you think there's room to cut more than 50 basis points?
I think there is room to cut more than 50. I would caution against wanting to follow the US route and try and stimulate growth aggressively by cutting interest rates. The US has got themselves into a big hole as a result of that. The Reserve Bank should be looking at other things like the level of debt and all the other various macroeconomic imbalances. That should determine interest rates. But having said that, yes, if you look at all these numbers, you look at the slow credit growth, you look at the very good inflation number, difficult to see anything else but a half a percentage point cuts at the next meeting. And yes,
perhaps
there must
leave the door
be
open
possible
for one
room
later.
for further, yeah.
You said it would potentially have a small impact on the property market, but wouldn't it just give consumers a little bit more confidence that at least interest rates aren't going up?
I think it provides, at the moment, rate cutting has provided more relief for a lot than actual stimulus. Yes, the big interest rate, if one looks at the mild response to 5 percentage points worth of interest rate cuts last year up until August, that was a big rate cutting phase. And you got a very, very moderate response in terms of residential property demand and so on. So it's difficult to see at the slow pace they're cutting now. Even with some moderate further cutting, it's difficult to see that offsetting the departure of that big stimulus from the numbers, because that big stimulus from last year is starting to wear off now. And the slope, unless the Reserve Bank were to unexpectedly ratchet up the cutting and cut aggressively, but I'm not sure one can, I don't see that happening. I think they've signaled to us they want to move slowly now.
How about your growth outlook? Have you revised that as well? Because we had, of course, first half growth now about 2.3%. What are you looking at for the full year now, Nicky?
We're looking at about 2.8. So we've brought it down from below 3. We had 3.1 for this year, and we've revised it down. When we did the numbers, the forecast for the second quarter, it became apparent to us that the World Cup effect was not going to produce a more rapid growth rate than we saw in the first quarter. And then all sorts of base considerations comes to an effect. So you would have to have a very, very strong third quarter to get you a growth rate over 3% for the year as a whole. So as a consequence, we've brought it down to 2.9. Just to talk about the very slow response we've seen in credit to the cuts in interest rates, and John's quite right, it's been quite a significant stimulation that we've seen, and certainly by South African standards, interest rates in absolute terms are now, at about a 30-year low. And I think the reason for that is that there's a lot of other factors weighing on consumers' decision to either borrow and to spend. And the biggest one there is, of course, job losses, and not just job losses, the insecurity created by that. In other words, people do not feel secure about their future, and especially about their future employment prospects. So that's the one, I think, that is a major factor, and we certainly picked that up in the escalation that we've seen in bad debts. And then the other factor is, of course, that overhang of debt, which makes it very difficult for them to go out there and just borrow and spend.
What do you think, John, particularly on the job loss front, because I think you came in at the end of our conversation with the markets, and job loss is obviously an issue globally at the moment. Of course, we're getting those non-farm payroll numbers out of the US on Friday, and still sitting pretty close to 10% there.
Well, that's the big problem for the US. I mean, they've thrown everything bar the kitchen sink at the problem, cutting interest rates to almost zero, so they've run out of ammunition there. Huge fiscal deficit, ratcheting up the debt to GDP ratio. and still very little response. Hence my view that the US is in serious trouble, and I would be surprised if they avoided a double dip recession, because you would have expected, or I would have expected with this sort of stimulus, to have seen by now more progress in reducing that unemployment. It's still at high levels, last seen in the early 80s after that oil price shock, and if I remember, there was a double dip at that stage. Consumer confidence there is dismal. The US is in trouble. There's a good few years that this financial crisis for the US, I don't think, is over. It's got a long way to run.
Do you think if they did fall into a double dip that other countries would naturally follow, countries like South Africa?
Well, I think the risk for South Africa is very significant. Obviously, our Reserve Bank still has significant ammunition to cushion the blow. So it's difficult to say for certain we would go into recession, but the risks must be very high. When the US goes into recession, it is still the biggest economy on the planet, and it does still wreak havoc for the rest of us.
Of course, with this uncertainty, people don't want to go and buy new houses or buy a new car, do they, Nicky?
No, exactly, and I think that's what we're seeing in the numbers, and that's why you have such a slow response. I really do think that the US, I agree with John, the US is in trouble, but I think that actually the stimulation is the right thing to do. If everybody wants to turn off the tap at the same time and everybody wants to export, I don't know who they're going to export to if demand is simultaneously falling. So for the world economy's sakes, one country should at least continue to stimulate. So I think Bernanke is reading the situation, in my opinion, 100% correct. And if you look at some of the Jackson Hole comments that have come out, I think they truly understand the complexity and also the severity of the problem. And that's why they're willing to embark on the second round of quantitative easing. And at this point, it's all that they've got left, and they've got to give it their best shot. And if you've got such a reluctant consumer, and you don't have a rapid runaway credit, the chances of inflation emerging with such excess capacity is very limited at this point. So I really do think, and I hope, that the US manages at least to prop up confidence during this period. And I think it all comes down to confidence. If they can manage confidence, we may avoid a double dip recession. If they fail to manage confidence, and you've got another series of panic and risk aversion, and all of the sort of things we saw play out after Lehman Brothers went down, then I think a double dip is pretty much guaranteed.
Well, how do you weigh up what the US is doing compared to what Germany and other European countries have done with austerity measures, where we see growth in Germany coming out at 3%? We have countries like Sweden with growth of over 4% at this stage.
Yeah, I think smaller economies possibly get it right. They can still run on other countries' stimulus measures. So in other words, if the US, being the biggest one, were to carry on stimulating its economy, smaller countries can to a certain extent benefit from that and keep their growth going. The US doesn't have anywhere to turn to. It is the biggest one, and if they don't stimulate their own economic growth, they are going into recession. So
it ties in with what
given
Nicky
the
was
corner
saying,
they've painted themselves into through years of very slack monetary policy, there's not much else Bernanke can do. He's got to make the best of a bad job. But I think the lesson, Stephen, that we must learn, or our Reserve, and I think by and large they have learnt it, is you don't try and aggressively stimulate growth with interest rate policy. Interest rates must be used to keep certain macroeconomic imbalances from getting too far out of hand. The US hasn't done that, and that's why they're where they are. We still have chance to not go that route.
Well, have we used our monetary policy tools effectively, do you think, if we have inflation down at 3.7%? Of course, there are some risks to inflation going forward, such as all these wage hikes and electricity price increases and things. But do you think that the Reserve Bank has been quite prudent?
I think the Reserve Bank has. Some will make the argument they've been too conservative. And I think that in certain interest rate cycles, that argument could certainly be made. I mean, if you now look back at that period when they were hiking interest rates, when food prices were rising and petrol prices were rising, but it was very, very clear already by then that the property market was slowing, that consumers were very indebted, and that consumers were in trouble. And they continued to hike as late as June 2008, if you recall that. So there have been periods that they have been too conservative, and perhaps, you know, if they started cutting sooner, I don't think you would have avoided this particular recession, but you may have avoided the extent to which we declined or contracted at the end of the day. But generally, yes, they've been very conservative. If you think that is a good thing, then you would be a supporter of their policies. We think that they've played the cycle relatively well. We do believe they hiked too much in the previous cycle, and they could have started cutting a lot sooner because it was to us pretty clear what was about to unfold. But other than that, they've done their bit, and they certainly do think about things very clearly. They do argue them out very thoroughly, and they do weigh up the risks attached of overstimulating, I think sometimes more than the risk attached of over-tightening.
And John, if we do get an interest rate cut again next week, when do you think we're going to have the cycle turning, and when are we going to have our first increase in interest rates?
Well, our group's view is for late next year, but I think there's a real risk given, you know, and a lot depends on how the global economy unfolds. If you are going to have some sort of double dip, I think it would be they would be on hold, any hikes would be on hold for considerably longer than that. So yes, late next year is our group's sort of opinion that they will start to rise mildly, but I think there's more downside risk to that at the moment than upside risk.